It was a big week for tech stocks, with 4 of the Mag's 7 members reporting quarterly results. These are some of the most powerful and expensive companies in the world. As part of our tech investing playbook, we want to talk about how investors can understand whether a tech stock is worth the price. One of the most commonly used metrics to measure value is something called the PE ratio, which measures a company's share price relative to its earnings per share. So here with more, we've got Jessica Inskip, who is the Director of Investor Research at stockbrokers.com. Jessica, good to see you. Good to have you back here with us. So help us dig into this definition, starting with what a PE ratio tells us about a stock versus what it doesn't tell us.
Yeah, absolutely. So like you said, we're looking at the price relative to its earnings. You may look at Berkshire Hathaway, Class A, and say that's a very expensive stock, and then compare it to Apple and think that that is less expensive, but that's really not normalizing it. So a PE ratio gives us an equal playing field, so we can normalize it and understand if it's expensive relative to its earnings in comparison to something else that could be a sector, another security, the overall broader market. And it essentially tells us, the definition anyways, what investors are willing to pay for $1 worth of earnings. But it's important to take that such a step further when interpreting it. So, for example, if something has a very high PE, it always tends to be tech stocks because it's the price divided by earnings. If there is higher earnings potential, that means there's going to be a higher PE ratio. But we expect that from tech because it's growth, where you might have something that's more low beta, like a consumer staples, that's going to historically and currently have a lower PE ratio. So we have to think about the numbers and the math equation to really utilize it.
Okay, so let's take this one step further and expand it a little bit. What about trailing PE, price to earnings, versus forward price to earnings, and how are those different, and when should you be kind of applying your knowledge around each of those?
That's such a great question and a very common misconception, especially in the self-directed investing world. I see lots of investors look at the trailing 12 months to understand if something is expensive or cheap in terms of valuation now. That's not necessarily true. We want to look at a forward PE ratio. Right now, the S&P 500's current forward PE ratio is 20.3. Historically, their 10-year average is 18.3 and the 5-year is about 19.9. It's more technology driven because of this AI. So I expect we're seeing those averages increase higher as well. But that is telling us forward expectations. We want to know, what is the earnings potential of this security that we're looking at? Tech specifically, how is AI going to translate into earnings? That's constantly what we're saying on finance media. I expect this AI agent to translate positively into earnings. If that translates positively into earnings and we have higher growth expectations, well, then that's going to transfer into the way that we look at PE ratio. So meaning, even if you see something that has a high PE ratio because the price is inflated, and you may think that the divisor isn't necessarily true. So when we're looking at this, we want to decide, is the price where I think it's going to be? That's the top way, or the very common way that PE ratio is utilized with that trailing 12 months, which is the past. Whereas the way to look at it for a future investment is looking at forward earnings potential. And you're going to decide, is the price too high? Or is the earnings potential not high enough or low enough? And there are lots of other factors we can look at to make those decisions.
And so some of the sky-high valuations that we started off the year with have improved a little bit, retraced just a smidge. The excitement of AI that you were talking about, and all of that considered, is PE still the best tool to measure the true value of tech stocks, or is there something else you're looking to?
I think it's great to have a well-rounded toolbox. So it's important to look at forward PE ratio. That's our first step. Then I want to look at earnings growth and earnings expectations. And I also want to look at profit margins as well. That's extremely important. And then we have to consider our macro view as well. If we're in a restrictive environment, usually, because there's a lot of CapEx spending, there is a lot of borrowing that occurs. Well, if they're going to have to roll over their debt and pay more for borrowing in order to innovate, if interest rates remain high or elevated, that that could be bad on the earnings potential. So you have to think about the overall equation. So it's important to think about other types of like positive cash flow is a really great example. But you can also even layer on analyst expectations. You don't have to necessarily go into the details of this, but the starting point, I think, is great to utilize forward PE ratio and then layer on your process from there.
So how do you compare different areas of technology, like software versus social media? I mean, it's going to be different when you're looking at, say, an Oracle versus Meta platforms when it comes to value.
Absolutely. So this is where you have to do your homework. We can start with that PE ratio. I want to look at earnings per share growth. Going back to the basics here, because it's literally what you're saying if you think this is undervalued. I think earnings potential is not recognized. There should be a higher denominator here, and that's going to justify the super high numerator, which is the price part of the equation. You need to look at earnings expectations, and if you think that it's incorrect or not recognized, like in the case of AI, because we don't understand it. Just like back in comparing it to when the internet first came out, it was very difficult to evaluate because we don't actually understand how it's going to translate into earnings. But what we can look at, this is where the past is very helpful. Has the company been missing earnings expectations, or have they been beating earnings expectations? If they've been beating earnings expectations by a very large amount, well, that tells me that analysts aren't even doing a good job coming up with that E part of the equation. Therefore, you could justify those valuations. At that point, when the earnings potential is where I want to focus on with tech specifically. That's when we can compare against a sector overall, bring in those same numbers, drill down even into the industry, or even specific peers, putting Google right next to Meta, right next to Amazon, even though they're different business models, but related from an AI perspective.
Jessica, good to break down these definitions with you. Appreciate the time.
Thank you.
Big tech and AI have dominated market conversations over the last couple of years, with chipmaker NVIDIA seen as the darling of the space. The stock is up more than 1,000% over the last 5 years. But our next guest says the story of big tech dominance isn't new. Here with more, we've got Ahmed Banafa, who is the faculty professor in the College of Engineering at San Jose State University. Ahmed, great to have you here with us. Take us through the history of concentrated market leadership as you've studied it and how it compared to today.
Good talking to you, Brad. Well, I've seen this movie before. Here's what happened. We're talking about the Nifty 50 in the 1970s, and then we moved all the way, to the tech giants in the late 1990s when we have the .com, and then we have seen something about the FANG, F-A-A-N-G, in the 2010s, and now we're talking about Magnificent Seven. So the concentration is not something new. It's a matter of what they are presenting. Now, this thing about the cycle itself and what we have seen in the fantastic seven here is basically what they're offering. I mean, in few words, they're dominating certain areas, which is touching every level of the economy, which is AI, the cloud computing, semiconductors, and also the consumer platform. This is why it's really significant.
And so with this in mind, and I'm glad you brought up FANG, because we had seen that hit so many different iterations. It was tough to keep track. We saw it go from FANG to FANG Man to Batman at one point as well. I mean, there's so many different iterations of these, but one thing that is really interesting that came to the top of my mind for this conversation, which is how are these companies at scale different than they were when we were talking about the Nifty 50s back in the day?
That's a good question. There are three things that distinguish the seven, the Magnificent Seven, with the exception of Tesla, because they're going through a tough time now. But they're still a solid company. Number one is they make money. They have a lot of profit. And we have seen the earning from Meta, $43 billion, and the same thing from Amazon, $143 billion, and $70 billion coming from Microsoft. And today we're going to hear from Apple. That's number one. They're making a lot of profit. Number two, they have cash. They have a reserve that it is a cash, rich reserve. And number three, they are global. They're not limited within, the United States or a certain geographic area. So this is what makes this seven is different from the ones before.
So about 30% of the S&P 500 is now just these seven stocks. How big of a risk is that to the average investor?
It's really a high risk in this case. The reason for this, all what you need just two of them to stumble. and they have a bad earning or they have a bad future look, and now we're going to have 30% of them of the S&P 500 really suffering from this. The key thing here about it is the investors is looking at a very important point here, which is the AI. I mean, the AI is not just what the products the company is going to sell or the services. It's what they're doing inside the companies. For example, Brad, yesterday the CEO of Microsoft, he said that 30%, up to 30% of the code at Microsoft is done by AI. The same thing goes with Alphabet or Google. Specifically, about 25% of the code is written by AI, which means they don't need that many people, which is going to reduce the expenses inside the company, increase the sales of the services outside the company. This is the difference.
And so what makes these 7 companies so hard to dislodge from their place at essentially the top of the kind of chain that's really driving so much of the market fervor right now?
Well, what they offer and their position in the market and the market share they have. You're talking about a company like Amazon, and look at what their market share and what kind of services they offer. Look at NVIDIA itself. I mean, the king of the semiconductor, especially the AI chips. Every time you think we are getting to the end of it, they come up with a new chip. And you can run this one with Meta. Meta is trying to expand by having their AI services or having other services that they're offering to the consumers. They understand that the competition is really tough, and everybody looking at them as who's going to be the next, out of that 7, and then will take their place. But they understand this. They spend, billions of dollars in R&D, billions of dollars in making sure they understand the market, and they're going to be first in the market with a product that's related to the artificial intelligence. As we see, this one is actually the future of the market.
Amit, thank you so much for taking the time here with us. Really insightful discussion. Appreciate it.
Thank you.
This week, we're talking all things tech investing as we get results from some of the biggest names in the sector, one of which is Meta Platforms, making its next AI play by announcing an app meant to rival here ChatGPT and other assistant competitors like Claude and Gemini. And so we want to dig into one of Wall Street's hottest trades, artificial intelligence. Here with us, we've got Kimberly Forrest, who is the Boca Capital Partners founder and Chief Investment Officer. Kimberly, good to have you back here with us. Today we're talking about how investors should think about investing in AI. I'd love to just start with your overall thesis here for picking companies.
Sure. Well, I come to this industry from software engineering where I was doing AI. Can you believe the luck of that, right? So today is your lucky day. But regardless, I started in the industry in '99 where .coms were a craze. I did not fall for them because I had worked in software, and I'm looking at them going, I don't really get it. This company doesn't have a product, or this company is years away from delivering the product. So I have a very practical approach to looking at and evaluating technology. The first thing I ask is, what problem is this technology solving? And then at what price can it be delivered? And if that price is higher than the product or than the problem that it's being solved, I take a pass on it, and that might hurt, like in the short term, but you're going to be right in the long term. So that's what I'm doing, is I'm evaluating all this new AI stuff, saying, what problem does it solve and what's the price to deliver it?
Yeah, no, that's really brilliant. So as we're thinking about the investing and the different buckets, there are kind of 3 main buckets of generative AI investing. And, I kind of harken back to what we had heard from Mark Zuckerberg many moons ago. I think it was about 2 years ago, essentially, when he was laying out the vision for what their own investments would look like. And he kind of laid out the investment thesis as well in the buckets: applications. Those are the products that people get to use, like ChatGPT and Microsoft Copilot. There's also learning models, the so-called engine under Gen AI applications, such as ChatGPT-4 or GPT-4 rather, which powers ChatGPT. And then there's the chip makers that all of this sits on top of, and the data centers like NVIDIA and Taiwan Semi. So break down how you think about investing in each of these buckets, and perhaps we start off with applications where consumers are touching it.
Sure. Well, I think it's important to note that most of the stuff that we're doing is a replacement for search engines. And there's a good reason for that. People who want to use a search engine want to get an answer to a question, not kind of figure out what the sentence should be to the computer and then scroll through all of the links that come back as potential answers. So at the face, ChatGPT lets you ask a question and it gives you an answer. Now, how much are you paying for that? You might be paying the $20 a month or whatever to get premium service, but I'm thinking that is way, way under what it costs to deliver that service. So in the long run, either the price of computing has to come way down, or the price of accessing that has to come way up. The other thing is, if you're an investor in Google, you really have to watch this because, you know, ChatGPT and friends are eating Google's lunch. So that's one thing. I think playing the semiconductor layer is really smart because we don't really know what the end application is going to end up at, what problem it's really solving, because there's a lot of problems. But we know that it's going to be delivered on a chip. So that's been an area that I've been playing for the last, well, we'll say 6 years, not necessarily in reaction to AI, but there hasn't been a whole lot of compelling software companies to invest in that were solving good problems in my paradigm, where there's a clear problem, there's a clear solution, and it costs less than the problem.
Okay, and so the companies that are best positioned, who are your top picks and why?
So I'm going to concentrate on the semiconductors, and this is kind of weird. I love Micron. Micron is a weird, it's not really a semiconductor company. They're more in the area of memory. But they have been able to come up with fast memory that NVIDIA is using on their chips. And I'm thinking whoever is NVIDIA's competitor is going to be forced to use it's called DRAM. We're nerding out right now, but DRAM is really important for these chips that are doing the AI processing. So we like them. The second way to play this is software that designs chips. And we like Synopsys. And they are buying a favorite local company of ours called Ansys, which does engineering simulation where you can, you know, test out, do online prototyping instead of physical prototyping. And they do have a lot in the electronic design automation space as well, which is why Synopsys is buying them. But anyhow, so we like that company, Synopsys and Micron, and they're not necessarily directly in the line of fire, but I think a lot of whoever wins in the AI chip race might use their products.
Fortunately, Kimberly, our viewers are looking for that deep analysis that you just provided, so nerding out, totally kosher. Thanks so much for taking the time here with us. Well, this week, we're talking all things tech investing as we get results from some of the biggest names in the sector. Before you start investing here, you got to understand that tech isn't just one thing. It's an umbrella term with several other types underneath of it. So today, we want to break down the differences between all of the different tech categories. And for that, I'm joined by Luke ONeal, Catalyst Dynamic Alpha Fund Portfolio Manager. Luke, great to have you here with us. Just start by explaining the 3 different types of tech companies that are out there in the market.
Hey, good morning, Brad. Great to join you today. Thanks for having me on. Yeah, when we talk about tech investing, as you mentioned, it's not a monolithic concept. When we say we're investing in tech, it's not investing in just one thing. So typically, we're talking about investing either in technology hardware sorts of companies, and semiconductor companies being number 2. And then software and services, number 3. So hardware, semis, software, and services would be kind of your classic 3 areas of technology. And then you add in things like social media, which are, let's call it tech adjacent, which are certainly within the overall ecosystem.
And so within that, where is the largest strength within technology in what is an uncertain environment that we've heard about from multiple CEOs over the course of this earnings season?
Well, clearly the strength is it's very dependent on the exact time frame that you're looking at it over. Over the last couple of years, we've seen some significant strength across most of that of the entire ecosystem. And as we think about just over these last couple of months here, as we get the tariff headwinds, as we get more of the global trade mess that is going on, you're seeing more strength in areas that are less impacted by that specifically, and that would tend to be areas like software. Software being relatively safer from an impact on global trade, since they are primarily a digital delivery, cloud delivery type of idea, as opposed to needing to manufacture their goods. And so hardware companies that are manufacturing more significantly overseas tend to be more exposed to tariffs and some of the current geopolitical issues that we're facing today. The flip side to that, though, is quite frankly that the software companies, because of their business model, tend to trade at a much higher premium. And so when there is a flight to safety in the markets, like we've seen over much of the course of the last 2 or 3 months, you still see a downdraft in many of the software names simply because they were trading at a high valuation multiple. As you get some questions about global growth, that impacts corporate belt tightening perhaps and potential spend on software. And so there are different factors that are playing in to the downdraft that we're seeing in different parts of tech. But clearly, software would be kind of classically viewed as the safer from a global trade perspective in this current market environment.
Okay, so that considered, what is a healthy portfolio allocation to these different components within the technology sector, the different industries that sit underneath of that?
Yeah, so I think it depends a little bit on what your goal for a portfolio is. In our fund, which is a classic trend-following, momentum-oriented strategy, we actually have exposure to to really all of those types of technology. So we've had an overweight for the last couple of years in that hardware area, which, again, over a medium-term perspective, has continued to be a great place to be in the overall markets. And we still think that there's plenty of opportunity in that space, and understanding that area of hardware is not monolithic even in its own case. So you have a company like Flex, which manufactures a tremendous amount of their electronic components overseas and is far more exposed to the global trade war sorts of issues, relative to another holding of ours, a company like Motorola Solutions. So Motorola clearly has some foreign manufacturing. They've moved largely away from China, but their end user and buyer tends to be government entities and police forces that are using their two-way radios, et cetera. Those tend to be critical infrastructure types of ideas, which the potential to pass through costs is much more significant there. And so you're seeing a very different sort of action in even different types of hardware stocks. But then we also have significant exposure within the software space to companies like CrowdStrike, which again are in a sweet spot from a secular growth perspective and are not tremendously impacted by the current issues that are plaguing the geopolitics area of the world. You think about semiconductors, clearly semiconductors are in the sweet spot of, or maybe the opposite of that from a global trade perspective, very sensitive to global trade concerns.
Yeah.
But semiconductors are also perhaps as strategic and as secular of an idea as you can think of from an economic growth over the next decade perspective. So having some exposure there continues to be important.
Luke, I got 45 seconds left for this Rule of 40 question. How should investors who are trying to figure out their exposures to the technology sector think about what is commonly known by many investors, analysts, and executives who run these businesses as the Rule of 40, and how it spells out some of perhaps their investability profile as well?
So I guess I'm not as familiar with the exact details of the Rule of 40, so I won't answer that question real specifically. But we think that having that balanced exposure across hardware, software, semis, and even services is really important to a long-term portfolio.
Absolutely, and just as education for our viewers out there, essentially it's just the revenue growth rate plus the profit margin equal or exceeding 40% there, which really gives them a sense of what the perhaps future holds for a company that is trying to grow out and scale its business, hyperscale in some cases. Luke, great to see you. Thanks for breaking this down for us.
Thanks, Brad. Have a great day.
You too.